Hello financial fans, welcome back to another stock analysis. Today we'll be covering Verizon stock ticker VZ. Verizon Communications is one of the largest telecommunication companies in the United States. With a diverse range of services, Verizon offers wireless communication, internet access, and television services to both individual customers and businesses. As a leading provider, Verizon operates a robust network infrastructure that spans across the country, ensuring reliable and high-speed connectivity. They also offer innovative solutions such as 5G wireless technology, fiber optic internet, and advanced entertainment options. With a strong emphasis on customer satisfaction and technological advancements, Verizon plays a vital role in shaping the modern telecommunications landscape. The company is currently sitting at a market cap of $150.4 billion, and their revenue in 2022 was sitting at $136 billion, and the dividend yield is currently 7.55%. 71% of their revenue comes from services, 21% from equipment, and the remaining 8% from various other income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone down over the years, going from almost $32 billion in 2013 to $31.4 billion in 2022. The EBIT growth is still 2.1%, seeing as they had a lot of years where they had a lower EBIT. But this does not qualify for a margin of safety deduction or increase. The margin has also gone down over the years, going from 26.5% in 2013 to almost 23% in 2022. There is still a 0.7% margin growth, which is no change in the margin of safety once again. The next two ratios are the dividend growth and the payout ratio. The dividend growth during this period on average was sitting at 2.4%, which is a 5% increase in the margin of safety. This with the payout ratio that's currently sitting at 50%, which is no change in the margin of safety on this metric. The final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For Verizon, this is over 3.5 years, in this case a 358% debt to EBITDA ratio, which is a 5% increase in the margin of safety. The return on invested capital for Verizon is sitting at 6.4%, which is no change in margin of safety on this metric. Looking not that great so far for Verizon, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of Verizon going from 2014 to 2022. The average growth rate in their free cash flow during this period was 21.31%, and I'm projecting an expected growth rate of their future free cash flow of 5% for the next 10 years. And with this percentage, we'll determine the future free cash flow for Verizon and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $288.3 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $114.6 billion. And dividing this by the amount of shares outstanding, we get the discounted cash flow price per share, sitting at $27.29, which is a 21% downside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Verizon coming from 4 years ago to the current year. On an average, their growth rate in their dividends was 2% during this period, and I'm projecting expected growth rate in all of their future dividends with 2% as well. I will once again be using a discount rate of 8.5% in this valuation, giving us a price per share out of this model of almost $41, which is a 18.44% upside from the current price. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Verizon is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the company with no growth should always be sitting at a PE of 7, or lower, of course. This gives us a fair value, looking at all of these metrics, of $35.98, which is a 4% upside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Verizon. look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 6.7. All we have to do to get a fair value of this metric is to then multiply by the earnings per share that Verizon is generating, which is $5.14 a share, giving us a fair value of $34.44, which is very close to the current price, with only a downside of 0.4%. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years. On an average, it has been sitting at 4.85%, while the current yield is sitting at 7.31%, indicating that it's currently undervalued this metric. Doing the same with the PE ratio, on average, it has been sitting at 9.28 on average on the past 5 years, and it's currently sitting at 6.73%, indicating that it's once again undervalued on this metric as well, giving us a fair value of $49.90, which is a 44.3% upside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's look at the final overview of a valuation next. Looking at the final overview, we've imported the discounted cash flow, discount dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $37.71. Without a margin of safety, we would get an upside of 9%, but we have determined our margin of safety earlier, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, and the dividend growth, giving us a margin of safety of 35%. Then applying this margin of safety, we get a fair value of $24.51, and with the current price of $34.58, we get a downside of 29.1%, indicating that out of our models, we get a sell rating. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.